Hi, everyone. This is for my ACC 204 course, Tax Accounting. We are in Module 5, Chapter 6. We're in the second week. So I wanted to just highlight a few key items as you're going through. I know some of you are finishing up the homework. I've had some questions via email. If you do have questions, please email me. Happy to answer. We can also schedule a time to coordinate via Zoom if needed. Happy to help out. I didn't have anyone attend the 3 o'clock today, so I cut it at around 3:30. But I am happy to meet on Wednesdays at 3. If anyone's interested, just let me know. So we're in Chapter 6. We're talking about deductions and losses. And if we skip ahead, we're going to talk about deductible expenses, right? So there's two types of deductible expenses. There's deductions for AGI, adjusted gross income, and deductions from AGI, adjusted gross income. Adjusted for AGI are the above the line deductions from income. And the line is the adjusted gross income. So when you look at the tax return and you get, I believe it's, well, the final is on line 26, but when you get to the adjusted gross income calculation, when you go above that line, there's certain deductions that you can take from your gross receipts that will get you to the calculation of adjusted gross income, which the slide's called deductions for. After you calculate adjusted gross income, we're going to be looking at deductions from adjusted gross income. So if you choose to itemize your expenses, we talked about in the past standardized deductions. We talked about whether or not you would choose to itemize. Here, we're going to look at some itemized deductions from AGI. But the above the line is for AGI, and from AGI are deductions that will come after you calculate the adjusted gross income calculation. And these deductions must exceed the standard deduction. Otherwise, you would not choose, or you cannot choose to itemize your deductions. So whenever you hear deductions from AGI, these are deductions after adjusted gross income has been calculated. They're deductions below the line, meaning below the adjusted gross income calculation. And these deductions are expenses. They're expenses that were incurred in the tax year, which we can deduct from the adjusted gross income to get us to taxable income. And taxable income is that line 26. The amount of income that you actually owe on, right? You don't owe your tax based on adjusted gross income, you owe a tax based on taxable income. So the way the order to work is we have gross receipts, right? And then from the gross receipts, we have our deductions for, or above the line deductions for adjusted gross income. That gets us to adjusted gross income. Once that's calculated, we then have our deductible expenses, which we can deduct from that adjusted gross income calculation, which gets us to a taxable income. So the above the line, the for AGI columns, right? The expenses that we could deduct before we calculate adjusted gross income would be alimony, expenses attributed to a trade or business. So if we have a trade or business on a Schedule C, those expenses can show up on the above the line adjusted gross income formula. Any business expenses that were incurred but we didn't get reimbursed for, so if we travel for business but we didn't get reimbursed, we can deduct that for above the line the gross income to get to our adjusted gross income calculation. Other common ones would be student loan interest. So you're allowed to deduct your student loan interest before you calculate the adjusted gross income above the line. You're also allowed to deduct any contributions to a retirement plan. So all your 401ks, 403bs, you're allowed to deduct above the line deductions. I'm going to skip the section 12 expenses. Section 162 is the trade or business deductions for a business. These are important. These are deductions for a AGI, right? So these are expenses that are deducted above the line to get to the actual business or trade income, which is calculated on a Schedule C on the tax reform, right? So Section 162 deals primarily with trade or business deductions. The typical trade or business deductions that you'll see would be reasonable salaries, paid for services, expenses on behalf of the business. All these can be used to deduct against business income. Things that we cannot include, and you'll see this on some of the homework questions, we're not allowed to include charitable contributions or gifts from the deduction for business income. So if the business has a charitable contribution or a gift, the business cannot deduct that. And again, this would be a business owned by an individual or partners, multiple individuals. You're not allowed to include any illegal bribes, kickbacks, anything that's illegal. You cannot include as a deduction for business expenses, and any fines incurred by the IRS, penalties, other government agencies, you cannot deduct. So pay attention to that. There is a homework problem there. To be deductible, the expenses must be ordinary, normal, right? Customary for other businesses in nature. And then, basically any expenses that are incurred that you need to conduct a business, you're allowed to deduct for adjusted gross income under Section 162. So I provided a link to the IRS code under the Cornell site in the very beginning. It's in the announcements. You can actually go and look at Section 162 in the code for any questions on business deductions that are for AGI. Now we'll get into the from, right? So expenses from AGI. So these are expenses that we can deduct and itemize after we calculate adjusted gross income, which is why we call it from. You can also call it below the line deductions. Typical deductions would be contributions to charity. So as companies cannot deduct, or a business, I should say, if you own a business, you can't deduct charitable contributions from the business as an above the line for AGI calculation deduction, but you can calculate it below the line. So if you're an individual, I should say, let me stop. If you're an individual, so on the individual side, an individual is allowed to deduct charitable contributions as a deduction from adjusted gross income. Businesses cannot. Mortgage interest is a popular deduction from AGI as an itemized deduction. State and local taxes, although state and local taxes are capped at $10,000, but state and local taxes are allowed to be deducted. Medical expenses, if you exceed a certain threshold, you're allowed to deduct medical expenses and any casualty losses, right? So if there's any casualty losses incurred, this is a deduction on the itemized deductions. But the most common that you'll see would be charitable organizations, or any charities that you contribute to. Mortgage interest and state and local taxes are the big ones. Medical expenses as well, but the other prior ones are the big ones. Businesses, so business losses, right? So losses by businesses, you're allowed to look back 2 years and carry forward. So you're allowed to deduct certain business losses. Qualified business income is a new one. This is really important. So qualified business income, if you are a member or if you're an owner of a business, either as a sole proprietor, a partnership, or an S corp, and we just described those businesses earlier, you're allowed to deduct up to 20% of qualified business income. And there's a whole section on qualified business income. But for this course, just know that you're allowed to deduct up to 20% of qualified business income that the business produces. It needs to be a qualified trade or business. There's a whole listing on the IRS code of a qualified trade or business. But for this course, just know that you're allowed to deduct 20% of qualified business income if you own a proprietorship, partnership, or an S corp, if it's a qualified trade or business. There is a limit though, right? So the limit, so no more than $326,600 if married, filing jointly, or $163,300 if single or head of household. If it exceeds these limits, then the QBI deduction cannot exceed the greater of 50% of the W-2 wages relating to the business. So W-2 wages means the salaries that we pay the employees of the business. There is a limit if the income exceeds, if the QBI deduction exceeds a certain amount. we limit it to the 50% of the W-2 wages, so the employees of the business. Or it's the sum of 25% of W-2 wages and 2.5% of the unadjusted basis of qualified property. The second section, so basically what the IRS is saying here is that they're going to limit the QBI deduction to a certain amount. If you and then in excess of that amount, they're going to cap the 20% deduction to 50% of W-2 wages. I mean, you have lots of employees, right? So you need to be employing people. Or if you're a rental property owner, you go with option 2. If you own lots of rental properties, it would be 25% of the W-2 wages, and you're allowed to include some rental property, right? So the limit is phased out over 100,000 married filing jointly, or 50,000 if single. Here's deduction. So qualified trade or business means, sorry, let me just move this. So qualified trade or business other than a specified trade or business, and below is the businesses that are exempt from the qualified business deduction. But just know that this deduction does exist. You're allowed 20% of the income up to certain amounts, and there is a limit if you exceed certain amounts of the 50% of W-2 wages, or 25% of W-2 wages, and 2.5% of rental property. Talk a little bit about the method of accounting. So typically taxpayers are on the cash basis. If you have a business, it might require you to also be on the accrual basis. The accrual basis means that revenue and expenses happen when they are earned and incurred, versus the cash basis, which is revenue or income happens when you receive it. Expenses are allowed to be deducted when you pay them, right? And there's certain rules for businesses that follow the accrual accounting method. Please check the book. There's questions in the homework about what happens if you're an accrual basis company and you receive cash around the cutoff point of the tax return. How much do you keep as cash? How much do you defer till later on? So take a look at the accrual-based method. And then there's a 12-month rule for prepaid expenses. So taxpayers under the accrual method don't have to capitalize amounts paid to create a benefit that doesn't extend beyond 1 year. So if you're on the accrual basis, you could still deduct any payments that you made for a prepaid if the prepaid is less than 12 months. And then there's a whole section on illegal businesses, political contributions, and lobbying. So you could take a look into those. Lastly, because this will be on the homework, there is a section on the investigation of a business. So an investigation of a business is amounts paid or incurred to determine the feasibility of entering into a new business, such as travel, engineering, architectural surveys, legal and accounting services. The tax treatment of these expenses depends on the current business, the nature, the extent to which the investigation has proceeded. If the taxpayer is in a business that is the same or similar to that being investigated, then the investigation expenses are deductible in the year paid or incurred. So you can deduct those expenses if it's similar. When a taxpayer is not in a business that is same or is similar, the tax result depends on whether the new business was actually acquired. If not acquired, then all expenses are not allowed to be deductible. If acquired, you can deduct certain expenses based on the rules below. So please check those out. But those are the main items I wanted to cover this week. Thank you everyone for viewing the video. Let me know if you have any questions. Happy to help. Thanks a lot and enjoy the rest of your week.